Good afternoon, everybody, and welcome to the latest in our series of professional advisors working lunches, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Coumbe, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly just run you through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way, just to ensure there's no background noise and our speakers can be heard more clearly. I should also inform you that this session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. As usual, today's digital working lunch will qualify for 1 hour of CPD, and we'll be sending you your proof of attendance with that via email tomorrow. Now, for those approaching retirement today, there are reasons to be excited. Advances in healthcare mean we are living longer, and technological innovation continues to improve our quality of life. Yet retirement can be daunting as well as thrilling. Your hard-earned pension pot needs to fund your lifestyle in retirement. The transition away from guaranteed defined benefit pension income continues apace. All this, of course, means individuals have greater responsibility for funding a longer retirement compared with previous generations. Many recognise the benefits of keeping their pension pots invested when they retire, but staying the course brings risks. Many ask, why should I stay invested if I don't know how much money will come each month? Well, the purpose of this session is to explore that specific problem. And to address those challenges and answer any questions you wish to ask him, I'm delighted to be joined by Tom Danaher, who is the Investment Specialist Manager with a specific responsibility for the Baillie Gifford Sustainable Income Fund. Over the next hour with Tom, we will consider why income volatility matters for retirees and how it can be mitigated. What does natural income mean? And also, how do we think differently about income growth in retirement? Do feel free to put any and all of your questions to Tom using the chat function, which you will find in the bottom right-hand corner of your screen. If you wish to be anonymous when asking your question, then simply select my name from the drop-down list in the chat box before you type your message so that only I can see it. So, just before I hand over to Tom, let me quickly run you through our learning objectives for today. So by the end of this session, delegates will be able to assess the options available to those approaching retirement today, considering recent market movements, demonstrate why income volatility matters in retirement and how it can be mitigated, and explain the benefits of focusing on long-term income growth as opposed to short-term yield. That's all for your CPD. So I will now pass across to Baillie Gifford's Tom Danaher. Good afternoon, Tom.
Hi there, Hope. I'm going to share my screen. Hopefully you can see that now. Is that all good, Hope?
All fine.
Excellent. Well, thank you all for making the time for some CPD in the run-up to Christmas. And as Hope mentioned, this session is titled Living Longer and Prospering. And that's because we think here at Baillie Gifford that we need to completely reframe how we think about financial risk in retirement here in the UK. So traditional measures of investing are important, of course, but the real and fundamental risk that individuals face is running out of money. And why are we talking about this today? Well, we know there is increasing scrutiny from the regulator in this area. The FCA is currently looking at how advisors consider the impact of market movements for clients in decumulation. But also, more fundamentally, we know that this problem is growing and fast. So between now and 2040, the number of retirees is expected to rise by a third. And fewer of those retirees, sadly, will enjoy the benefit of a defined benefit pension compared with generations past. And instead, the retirees themselves are going to have to bear that risk of running out of money. So 5 years ago, Baillie Gifford set up an investment strategy to tackle this very problem, and it's called Sustainable Income, as Hope mentioned. And at the outset, there are three things you need to know about the strategy. I will tell you more than that during the next half hour or so. Its objective is for the fund's income and capital to keep pace with inflation over rolling 5-year periods. That's how we think that many retirees think about their pension assets. The second is that it's a multi-asset fund, because we know that the mix of assets best suited to keep pace with inflation will change over time, as it has done recently. And thirdly, topical at the time of SDR and those sorts of publications, sustainable has dual meanings for this strategy. Sustainable in the sense that we need the fund's income to last a lifetime, our clients certainly do, but it should also be compatible with a sustainable economy in an ESG sense of the word. So we're going to kick off today with Eleanor's assistance with a quick poll, just to check that you're all online and listening while you're eating your lunch. And the question on this first poll is, what's the biggest challenge your clients face today as they approach retirement? All three are challenges, but if you can select the biggest challenge that your clients face, please. You can see the responses ticking in. Okay, so you should be able to see the results on your screen now. So we can see there that the majority of people on the call have selected the third option, so ensuring that their clients' pension assets last a long retirement. These results are fortuitous because with the first problem, Baillie Gifford is not there to help. Understanding retirement spending needs, we see that as squarely the job of the advisors that we help. But with those second and third problems, so generating enough income and ensuring that assets can stretch a long retirement, that's where we are here to help, and we'll discuss a bit more of that during the course of the next half hour or so. So let's quickly look at how the investment backdrop has changed for those approaching retirement today. So prior to the pandemic, retirees had enjoyed a decade of fairly benign conditions, at least in the financial sense, in terms of having low inflation and fairly loose monetary policy. Fears over deflation in 2020 were rapidly replaced by rising prices during the 2 years that followed. And this chart here shows the inflation picture across the G7. And the grey markers on the chart there show the peak CPI rates in each G7 country during the past 2 years. And as you can see towards the right-hand side, the UK really has borne the brunt of this inflationary shock, with CPI peaking at over 11% last year. The blue markers show the latest inflation prints for each country. And this picture is much more encouraging. So in almost all countries, we've seen a marked slowdown in these price rises. And this spike in inflation, of course, led to a rapid change in interest rates too, which has had significant implications for retirement choices. So this chart here shows what has happened to interest rates during the past 2 years in these G7 economies. So with the exception of Japan in the middle there, where the Bank of Japan has been a bit more cautious in its policy setting, we've seen really fast increases in interest rates across the G7. So towards the right-hand side there, the Federal Reserve in America has hiked 11 times, the Bank of England 14 times. And although we've avoided a recession in 2023, this chart here, it does represent a significant tightening of financial conditions. And of course, we've seen the impact this has had on asset valuations across the board, including in all the asset classes you might expect to find in a retiree's pension pot. So those two charts show the high-level backdrop. Inflation is above target, but much more under control than a year ago. And we've seen one of the fastest interest rate hiking cycles in history. Well, why does this matter? Well, retirees, therefore, have faced a real triangle of problems. The sharp rise in the cost of living, which we've all experienced, a similarly sharp decline in asset values, and now, as you can see from this chart, the return of risk-free returns from cash. So is it any wonder, as a question I'm sure many of you face, that many people in the UK are considering whether to stay invested altogether? So the question now facing those approaching retirement, as we said earlier, growing number of those people, is whether to lock in these higher returns available from cash. So let's look at how the numbers stack up today for a person facing that choice. We know that staying invested is not the only option for those approaching retirement. And this chart here shows a 65-year-old with a £500,000 pension pot and the rough annual income they would receive from 3 different pension options. So the first option there on the left, option A, is a fixed annuity rather. The second is an inflation-linked annuity. And the third option is to stay invested through a drawdown product. And for this, conveniently, we have used Baillie Gifford's Sustainable Income Fund for the illustration, which has a yield of about 4.2% today. So the blue bars show the income that our 65-year-old will receive next year under each of these options. So on the left, with fixed annuity rates at over 7%, our retiree receives a very healthy £35,000 in year 1. Unsurprisingly, the income from option B is lower as this insurance against high inflation is quite expensive. And thirdly, the income from staying invested is quite similar to that of the inflation-linked annuity, as you can see from the chart. Now let's roll the clock forward by 15 years. So by now our retiree is 80. We assume that inflation will compound at 2.9% per year, and that's our long-term inflation expectation. So the income from our fixed annuity, of course, doesn't change. The inflation-linked annuity rises by that 2.9%, as it says on the tin. And thirdly, that we assume that the sustainable income fund's distributions can keep pace with inflation. So taking its income from 21,000 to 32,000. That's in line with the fund's objective. So that's what we're trying to do. By the end of 15 years, you can see that the income from options B and C almost catches up with the fixed annuity by the very end. However, there is a sort of £500,000 shaped elephant in the room here. So under the 2 annuity options, you've handed over your capital in exchange for guaranteed income each year until you die. But under that third option, staying invested via a drawdown product, you are keeping that £500,000 pension pot intact. Now, yes, particularly as we've seen in the recent couple of years, the capital will be subject to market fluctuations. However, at least it stands a chance of growing over time. Let's now assume, as this chart does, that the capital value of the pot simply keeps pace with that 2.9% inflation. And this is a fairly conservative estimate based on historic investment returns. So by the age of 80, let's look at these outcomes. You've got a pension pot, which has grown by 50%, and an income level which has also steadily risen to match that offered by, almost match, I should say, that offered by annuities. But to be clear, we should say that annuities definitely have a place depending on an individual's circumstances. However, going back to that problem we mentioned earlier, we know retirements are getting longer, and we think there is a place for many people to stay invested for longer, at least with part of their pension pot. So after all, annuity rates also get more generous as you get older, without wanting to be too morbid. So you may have more capital at a later date to turn into a higher level of guaranteed income. So in other words, really keeping your options open. That's a summary of a few options that our retiree might face today. I'm now going to put that to the test in a second poll. I'm not going to do this after every slide. We've only got 3 of these today. But Eleanor, if you'd kindly share our second poll with the audience. And the question here is, how has your view of annuities changed during the past 12 months? Are you more, less, or equally positive or negative on the annuity market? Just wait for a few more responses to trickle in. Okay, so Eleanor's kindly shared the results there. I think I've got a fair bit more work to do in this area, judging based on those results. But no, unsurprisingly, a real sea change in annuity rates. And therefore, we should expect these to be more attractive to retirees. So anyway, for those who do choose to stay invested, what are the things that we need to think about? Well, a key difference between accumulation and decumulation is that the timing of returns matters more when you retire and start to draw on that pension pot. And I'll give you another example just to show this. So on this chart here, we have two retirees. One retires at the beginning of 1974, and the other retires exactly 1 year later in 1975. So 74 was a period of oil price shocks, high inflation, and rising interest rates. So does that sound familiar? Let's assume the retirees have identical pension pots, which are 60% invested in shares and 40% in bonds. So classic 60-40 portfolio. Each retiree draws 5% per annum from their pension. And you can see from the chart that their outcomes are wildly different. So the weak market returns in 74, combined with the pensioners' regular withdrawals, mean that our 1974 retiree ran out of money altogether within 25 years. Meanwhile, the 1975 retiree enjoyed a very comfortable retirement, helped by that significant market recovery at the beginning of their retirement. So how can we overcome or at least mitigate this sequencing risk as it's known? Well, the first thing is to recognize that we need a totally different approach to investing in decumulation. So as I say, pre-COVID, during that period of low inflation, positive growth, it's worth acknowledging you can achieve a better overall outcome by using a total return approach and simply selling down a bit of capital to supplement any income shortfalls. However, we are in choppier market conditions now, and the resilience of the income is becoming more and more important to our clients. So we think the answer to this problem that you see on screen is to invest your pension in such a way that it's focused on generating an income stream which is both attractive, but also natural, clipping equity dividends and bond coupons in a really straightforward way. By generating that attractive natural income stream, you are avoiding the need to sell down capital at inopportune moments, as our 1974 retiree had to their detriment. So in our sustainable income fund, that's exactly what we aim to do. So as I say, our objective is for our clients' income and capital to keep pace with UK inflation over long periods of time. So that summarizes where the market is today. The second part of my presentation today focuses on how we go about finding that resilient natural income. So first of all, what does the fund, Sustainable Income Fund, invest in? Well, there are three buckets of assets that we own in sustainable income. On the left-hand side there in blue, you've got our equities, and we'd say these are the growth engines of the fund. So in sustainable income, we look for dividend growth companies, which have industry-leading positions in their sectors, real financial strength, and a commitment to their dividend in good times and bad, which is really important to us. In the middle there in grey, you can see real assets. So for us, this means property and infrastructure companies. It's worth noting that in property and infrastructure, everything we own is listed, which means our portfolio is highly liquid. And again, we look for companies with what we would call mission critical assets, and there'll be a bit more on that later on. Finally, on the right-hand side, you've got fixed income, which has really come back into play in the last couple of years. And these asset classes, varied though they are, contribute high levels of nominal income to the portfolio, as well as some ballast in difficult times. For example, if we were to hit a recession, the fixed income we would expect to come into its own. It's worth noting as well that Baillie Gifford has capabilities in each of these asset classes that you see on screen in-house. So that means we do not need to use external managers at additional cost. And each of these asset classes has a bespoke portfolio built for sustainable income, meaning that every underlying investment in the fund has been selected for its income resilience. And we've also kicked the tires on its ESG and sustainability credentials as well. So those are the building blocks of our fund. But what's the outlook for each of these asset classes going forward from today as a starting point? So here, this chart shows our return expectations for each asset class during the next decade. So the x-axis shows our expected income return, using today as a starting point, and the y-axis shows the expected capital return. And consistent with the example earlier, we will assume inflation is 2.9% a year. So it's worth noting, before we get into the detail of this, that these are the expected returns for our portfolios rather than for market indices. So for example, we expect our equities to achieve 7 or 8% capital growth during the next 10 years. That's an expectation for our equities, not an assumption for the wider equity market using an index, for example. And the same is true for every other asset class. So let's start with cash at the bottom there, marked by the purple dot. So that we know that the income return on cash is more compelling today than it has been for quite a long time. However, we also know that in a 3% inflation world, the value of our cash will halve in 25 years. So when it comes to retirement, this is not going to be the sole answer to a prosperous long retirement. On the right-hand side of the chart, the orange dots denote our various fixed income asset classes. And you can see that each of these fixed income asset classes provides a compelling level of income today, which is ahead of inflation. However, we do know that inflation will ultimately eat into the purchasing power of those bonds and the income that they produce. That's reflected in our capital return expectations, which are below the rate of inflation marked by the blue. Turning to the middle of the chart, we see the real assets we hold in the Sustainable Income Fund, property and infrastructure. And we expect from here that each of these asset classes will hold their own in terms of real income and capital growth during the next decade. Finally, we see equity returns towards the top left of the chart. So although that sub 3% yield, income yield, seems meager today, we think it's really important to have an allocation to assets that can achieve high levels of real growth alongside the other lower risk assets. And let's remember, we are funding a retirement spanning potentially 30 plus years in good health. So we need this capital growth to power the income growth many, many years into the future. And equities are really, really important for that. So that's the very big picture and the long-term outlook. I'll touch briefly on how we are positioned today. So this slide shows our asset allocation, and the turquoise dots on each asset classes show our current allocations to each of those asset classes. It's worth saying at the outset that we set our strategic asset allocation every 2 years, factoring in our long-term return expectations that we've just shared. The formal tactical asset allocation process is done quarterly. However, we can and do make adjustments whenever we see fit based on market conditions. An important consideration in asset allocation decisions is that we want clients to be able to rely upon their monthly distribution from the fund. To put some numbers on that, we have an investment guideline that the fund's distributions shouldn't fall by more than 10% in any given year, with a 95% degree of confidence. Even during the testing period of the pandemic, when stock markets endured widespread dividend cuts, cancellations, the fund adhered to that 10% guideline for a drop in income. And that was really, really important to our clients, as they didn't have to then sell down capital. One point to note is that you can see from the expected ranges here that flexibility is a really key feature of this strategy. It helps us to mitigate short-term volatility, but also to take advantage of valuation opportunities as well. And the flexibility showed by these wide ranges has been particularly helpful in navigating that big shift in the interest rate environment that's unfolded during the last 2 years. So let's give you an example. Towards the top of the page there, you can see infrastructure. So amidst the turmoil of last year, infrastructure was the only asset class, aside from cash, to hold value. And indeed, it produced positive returns in 2022, which helped to limit the drawdown of the fund. So we reduced our infrastructure allocation by 9% on the back of this resilient performance, as valuations across the other asset classes you see on screen started to appear more attractive. And that was particularly true in fixed income. Finally, I would note that you can see at the bottom there in purple, our cash allocation is higher today than both the strategic allocation and also at the highest level it's been since the fund was founded 5 years ago. And that reflects the fact that we appreciate the value of cash as having some dry powder, but also it doesn't now drag on the fund's monthly income production as well, which is really important for our clients. So that's how we're positioned overall. We'll now take a look at where the fund finds or sources its income. So the dots that you see on this map of the world indicate all the countries where the fund's income is generated. And you can see at a glance that the geographic diversification of this fund is really, really quite strong. And the examples you see on screen show 2 of our equities, 2 of our bond holdings, and 2 of our real asset companies held in the fund today. I'm just going to touch on one of those towards the bottom of the page, which is Turner. Turner is one of our infrastructure holdings. We often refer to it as the national grid of Italy. So it sits in the utility sector, which has been really difficult to navigate, particularly in the UK during recent years. However, Italy has a supportive regulatory environment, which is really important. It limits Turner's exposure to both end user demand and also volatile electricity pricing. And tariffs in Italy allow for operating costs to be passed through with an inflation adjustment. So the financial profile of this business is really strong. When it comes to ESG, Turner is critical, frankly, to Italy's energy transition, as substantial investment is needed in the grid to generate higher overall capacity. So in Turner, we have a company with strong and varied structural growth opportunities, a supportive regulatory backdrop, and overall very strong dividend growth prospects as we look out the next 5 years. So at that point, I'm going to introduce our third and final poll question with Eleanor's assistance. So as we think about where our income comes from, this question just focuses on that. So what matters most to your clients who take a regular income from their pension? Is it the total amount of income that's generated? Is it the volatility of that income? Or is it the volatility of their capital? Answers trickling in. Okay, so we have almost an evenly split room. Okay, brilliant. We've got around a third of people saying it's the total amount of income, and similarly about a third saying it's the volatility of that income, and a third capital volatility. I think the truth is that all 3 of these matter to someone in retirement faced with the daunting task of making their assets stretch a long way. We're now going to just touch on 2 asset classes in particular, just to illustrate how we think about generating long-term income. So touching on that income volatility point, but we'll also refer to the capital volatility as well. So you may know the 2 stock examples shown on this slide, Novo Nordisk and L'Oreal. And you may also know that both of those stocks have very low dividend yields today, yet both have proved to be excellent income investments for those that have held the shares for a long time. And we'll come back to that shortly. But as an income investor in retirement, just at a headline level, why is it important to take a global approach and not to obsess over short-term yield? Well, we know that many UK retirees disproportionately focus on our domestic market for their pension fund income. And this is logical given that the UK market offers a high yield today of around 4%, which is attractive compared with the other regions. However, we think there are three problems with putting your eggs in the FTSE basket, as we might call it. The first is shown on the left-hand side of this slide, and that is just sheer concentration. So if we look at the last 12 months, 44% of FTSE 100 dividend income has come from just 3 industry groups. And within that, it's come from just 10 companies. So there's a real concentration risk there for retirees focusing too much on the FTSE 100. The second is a lack of reliable dividend growth. So the 1.4% historic growth shown here makes those dividends sound stable, if uninspiring, but the underlying picture of how those dividends has progressed is really rather different. And the third problem is that this narrowness focuses out on the real growth engines of tomorrow. So we see on the right-hand side, those 10 companies in 3 sectors that form over 40% of FTSE 100 income are expected to grow their dividends by 3% on average during the next 3 years. So how are we doing this differently? Well, when we allocate to equities, instead, we look for companies with stronger structural growth drivers. And we often refer to sustainable income's need to generate long-term income for our clients rather than short-term yield. So we'll look at an example of 2 companies to make this point. So let's roll back the clock 10 years firstly, and assume that we invested $100 or pounds in each of these companies 10 years ago. So company A, shown by the blue bars here, is a company called Watsco, which you may be familiar with. It's a family-run business based in Florida, and it's also the world's largest manufacturer of air conditioning, heating, and refrigeration equipment. And Watsco is a company that's been held by equity income investors for several years. Company B is a well-known and widely owned oil major here in the UK. And this chart shows the dividend profile if we had invested the same amount of money in these 2 companies during the past decade. So in 2014, you're probably looking at that chart and thinking that Company B looks like a much more obvious income investment. However, we can see how the next decade panned out. Watsco, with a very modest 2% starting dividend yield, increased its dividends steadily, and that dividend payment ended up being almost 5 times larger at the end of those 10 years. So a really outstanding income result. Compare that with Company B, where we saw a significant fall in the dividend, and it's failed to recover even to that starting level. So if you look at the middle of that chart and think about how you feel as a retiree invested in Company B during 2020, you're faced with a dividend which halved. And by the way, the share price didn't look too pretty at that point either. So how do you supplement that income drawdown? Now, of course, Company B being an oil major, its dividend has rebounded as the oil price has recovered. However, today's dividend in pounds and pence, as you can see on this chart, is still lower than the dividend that you were receiving a decade ago. And we would argue that for our retirement clients, that's a really unsatisfactory outcome. Now, as an income investor, if you just locked these 2 stocks away for a decade, the total monetary value of the dividends that you see on screen there was almost the same. There's only a 1% difference during that time. However, as we touched on earlier, it's the journey that really, really matters more in retirement. So in the case of Company A, you can see on the right-hand side here that we see no drawdowns in dividends at all, while for Company B, the dividend halved from its peak. So Watsco's resilient growth was rewarded also in share price terms, as you can see on the left-hand side, with a share price compound growth representing 15% per annum during those 10 years, compared with less than 2% for the oil major. So the financial case is clear for looking for these companies that have the financial strength and the structural growth drivers to just steadily increase those dividends over time, even if you're starting with a pretty low yield on the day that you buy the stock. Finally, it's worth considering the sustainability credentials of those 2 businesses as well. So for each investment in the Sustainable Income Fund, we ask a simple question: is this investment compatible with a sustainable economy? And in the case of Watsco, It's accelerating that transition towards more energy efficient products in heating, venting, and air conditioning. Whereas for the oil major, that question is frankly a lot more difficult to answer. So ultimately, while these sorts of companies had been formidable income investments over many decades, the long-term dividend outlook is much, much more uncertain today. So that's an insight into how we compare and contrast different styles of income investing in equities. And the search for long-term income over short-term yield is also true for our real assets holdings too, so those in property and infrastructure. And this slide here shows the 6 factors that we think about when investing in real assets companies. So for a bit of context, we currently have about 15% of the fund invested in infrastructure across 21 underlying investments. Property is a much smaller allocation at 7%, but it's similarly diversified across 18 companies. So if we think about property for a moment, this is a sector which has been characterized by really high levels of cyclicality, but also dividend cuts during recent years. However, so it's not been the easiest place to find companies that can produce inflation matching or inflation beating dividend growth sustainably over long periods of time. But I'm going to touch on one property holding which has managed to do that, and it's held in the fund today, and that's Unite Group. So Unite is a London-listed REIT. It owns and operates university accommodation here in the UK. And Unite was the pioneer of third-party student halls back in the 1990s, and it's the #1 operator in that sector today. You can see at the top of this slide here that we do look for low economic sensitivity within our real assets holdings. And Unite's properties help to alleviate the shortage of purpose-built student accommodation in the UK today, which has worsened in recent years. In fact, we see that in many cities, including here in Edinburgh, where I'm speaking to you from today. So the shortage of supply in this very specialist sector underpins Unite's low level of sensitivity to the wider economy. Unite also benefits from having very short lease terms. So if you think about the annual turnover in student halls, that allows Unite's rents to be marked to market regularly. In other words, inflationary uplifts can be passed through really quite quickly. And again, that's been to its benefit in recent years. So Unite has been a resilient property investment. And one reason for that is its really prudent and sound financial management. So its dividend is fully covered. That's important to us. And it has a policy of paying out 80% of its profits as dividends. And finally, sustainability is absolutely central to our investment process. And Unite's a really interesting industry leader in that regard. So it's committed to becoming net zero carbon across both its operations and its property developments by 2030. So really quite ambitious. On the social side as well, Unite has its own foundation, and that helps to provide free accommodation to disadvantaged students each and every single year. So Unite is just one of the 18 property companies held in the Sustainable Income Fund today, as I mentioned. And we tend to find in property that it's specialist companies that are best placed to deliver resilient income growth. So our property allocation has a bias towards sectors such as logistics, healthcare, and also digital infrastructure, a growing area of the market. So you're much more likely when you look through the underlying holdings of sustainable income to find those sorts of companies rather than offices and shopping centres. So we've covered what the investment landscape looks like today for retirees, as well as why income volatility matters and how we go about mitigating it. I've also finally covered how we think about the need to focus on income growth to provide for what could be a very long retirement. And to conclude, we think today's environment is different to the one than when we launched the fund 5 years ago. There is a real need to be nimble in this environment. So the mix of assets best suited to keep pace with inflation is likely to evolve. And we're here to do that for you through our asset allocation process. We spoke about how investing in decumulation needs to focus more on that fundamental risk of people running out of money. And we know that more people will face this challenge during the next decade as we all live longer and become increasingly dependent on our private pension pots. So sustainable income, we feel, is designed to meet that challenge, to solve a growing real world problem, which frankly, we're all going to face sooner or later. So that concludes my formal presentation and remarks. And with that, I'll hand over to Hope for questions.
Thank you very much, Tom. As we've just heard, there is some time now for some questions, so please do type them into the chat box. Tom is ready to hear your thoughts, your comments, anything that you would like to share. I'd like to just start off quite broadly, Tom, and just ask about your big picture outlook for UK retirement. There's so many solutions, like you outlined. Why do you feel there's a need for even more in this space?
I think it centers on the fact that the way in which retirement income is evolving it's very gradual. So if you think about defined benefit pensions that have dominated much of the last century in the UK, as those slowly come to an end, closed, of course, to new members in the private sector at least, that sort of dependence on defined contribution is going to be quite mammoth, but it's also quite slow moving. So we're starting to see people retire with DC pensions, but actually that's still in its fairly early stages. So, you know, as time goes by, we're going to have more people facing the sorts of questions that we focused on today. And, you know, many people don't want to overcome those choices by themselves. They want something really simple, focused on the things that they care about, which in many cases is as simple as how much money is going to hit my bank account every month. You know, that's what they think about in their working lives. And frankly, that's how a lot of people think about retirement too.
As you were saying, there's been a lot of innovation recently in workplace pensions where perhaps it had been a bit more stagnant. Obviously, just recently with the autumn statement, we heard about the idea for pot for life. So with so much change happening, how do you keep up with that when you're looking to innovate in this ever-changing space?
Yeah, so you know, that seems like a sensible suggestion in having one pot to keep an eye on rather than 10. Just at a practical level, that seems like a sensible change. I won't comment on the practical challenges that causes for employers and so on. But you know, there is a constant need for innovation in this space, and part of that is to do with market movements. You know, as I mentioned during the presentation, it's actually been a relatively straightforward period to just be a total return investor. So you might change the funds that you're invested in retirement versus your accumulation stage, but just selling down capital as and when you've needed to, that's been fine until 2 years ago, when we've seen markets really be a lot more volatile. And, you know, investors faced with having to sell down capital at, frankly, really weak prices in order to supplement their income. And that can have a devastating impact if it happens repeatedly over time. So what we're saying with sustainable income is, right, we know roughly what these challenges are. We want you to have an income that you can rely on, but we're not going to neglect your capital in order to do that. We're not going to overreach for yield. We're not going to delve into the areas of the market that are more traditionally associated with income investing. And that's how we would say we're different. So if you look at how our fund compares with other decumulation options today, people on the call would probably look at it and say, okay, a yield of 4.2%, I can get more elsewhere. But we would just hammer home the point. That money might have to last 30 years. So if you're going to maximize income today, you're probably making some compromises elsewhere. So that's how we're hitting the innovation button in this space.
Great, thanks, Tom. We have a listener here who has asked, what are your views on the 4% rule?
I guess it's not cut and dry. You know, yeah, as a rule of thumb, it's proved to be pretty good over time. I would say in my previous life before coming to Baillie Gifford, I was a wealth manager. And, you know, the 4% rule sounds very good, but life happens in between. And so, you know, that sort of linear path is just frankly not how life pans out for most people. So it's tried and tested over time, I'd agree. But the real risk with the 4% rule is that you have so those weak returns at the early stages of your retirement, and then you're having to take that 4% in whatever form, potentially at a really, really bad time. So if we can try and mitigate or remove that risk as much as possible, we're probably doing a long-term service to our clients by doing so.
Great, thank you. Now, we've had obviously a really, really tough time economically in the last year, perhaps even slightly longer. Things look to be stabilizing a little bit now. So with that in mind, can you just talk us through some of your recent changes to asset allocation?
Sure. So as I mentioned, we've increased the level of cash that we've got in the portfolio, just to have some dry powder. And one of the reasons for that is that, yes, you know, as I showed, inflation is headed in the right direction and interest rates probably have peaked. But the market knows that. And what we see today is actually some quite aggressive pricing in of interest rate cuts. And we've seen that particularly during the last month, you know, in the UK, America, and the Eurozone to varying extents. The market is saying, right, we've peaked, but also we're going to come down in terms of rates really quite quickly. So that probably limits our enthusiasm to add to fixed income at this stage. We've got this ongoing tussle in our minds between the market probably being a bit optimistic on rate cuts, with also just some really attractive yield numbers. So one area of fixed income that we've added to this year is investment grade credit, where we think you actually paid a reasonable spread for companies that are extremely high quality with very low default risk. So we've added about 5% to investment grade credit during the past year or so. So we are being opportune, you know, we're seeing great opportunities. Income investing is back, if you like, but you've got to tread carefully as well at the same time. There are parts of the market where valuations are maybe a little bit demanding.
With all that in mind, then, I'd be very interested to hear, I'm sure everybody listening in would be as well. What's the biggest mistake you've made this year, and what do you feel you've learned from that you're taking forward into 2024?
Scratch my mind for a mistake we made. No, I'm sure there are many, Hope. I guess one of them actually is probably to have a bit too much cash in the last couple of months. Markets have just been gyrating wildly. And particularly in the last month or so, we've seen a really significant rally. Of course, in hindsight, you'd like to be fully invested and in the highest risk areas at that point. But, you know, we are mindful that we're on a bit of a tightrope here. We've got compelling return opportunities on the one hand and aggressive market expectations on the other. So I think we probably this is very short-term thinking, but maybe we underestimated the extent of risk assets to rally really quite hard during the past month. So having any cash was too much cash on reflection during the past month or so.
Fantastic. Now, somebody has sent in a question asking about SDR. What are your thoughts? What work have you been doing? And what do you think advisors should be thinking about while they await further news on their side?
Yeah, so I'm not going to give you a sort of scoop here, Hope, in the sense I'm not going to commit us to one of the labels that the FCA announced last week during this call. Needless to say, we're working on it really quite hard at the moment. What we would say is, you know, this is particularly for multi-asset funds. This is a really, really complex space, because if you look at the sorts of things that we invest in this fund, yes, you've got equities like Microsoft or Novo Nordisk, which you can assess pretty readily, and there are plenty of people out there who do. But then we've got other asset classes which are frankly a lot more difficult. So if you take emerging market bonds, you know, how do we measure the sustainability of a Peruvian government bond? And this can become really complex really quickly. We adopted the name sustainable income earlier this year to reflect the fact that we want to deliver sustainable income, yes, but we also want to do so in a way that's compatible with a sustainable economy. And we try and simplify that task as much as we can. So that overriding question, is this investment compatible with a sustainable economy? Yes, we can ask that of Microsoft, but actually we can also ask that of an emerging market government bond too. So what I would suggest is, try and keep these things as simple as you can. There are various complex inputs that go into each of these assessments, but try and keep it simple so that our clients can actually understand it. I think one of the dangers with this is that, we end up with a lot of jargon that is not intelligible to the end user. But what we try and do with this product is try and keep our assessments really, really clear in our materials. But there are lots of briefings out there on SDR, and I'm sure we'll get more during coming weeks as well.
Excellent, thank you. So going back there then to the fund, you spoke a little bit about total return investing and about what makes the fund different, but can you just clarify a little bit more about how the approach differs from retirement target date funds, for example?
Yeah, sure. So we've done quite a lot on comparison with total return, but if you take retirement target date funds, they have been pretty popular here in the UK. And yes, they follow a tried and tested path. However, what we would say is if you reflect on the experience of the past couple of years, if you had a 2025 retirement target date fund, that would, quickly get you out of equities and towards safe government bonds, almost regardless of the valuations of those asset classes. So if we think about what that does, it can either reduce your level of income if you buy the wrong bonds at a high price, or it just doesn't have that same valuation discipline that you can have with a slightly more flexible approach. So, in the last couple of years, in this fund, we were able to hedge out some of our duration, which helped us during the bond market sell-off. But also, frankly, we just had a really low allocation to developed market government bonds. So no gilts, a small allocation to US Treasuries. So retirement target date funds, sure, have a place, but you can end up being an almost indiscriminate buyer of assets that are really expensive and inadvertently increase your sort of short-term risk.
I'm interested to hear about your mix between domestic and international investments as well, particularly when we look forward into next year. Obviously, there's a lot going on in the world geopolitically at the moment. We've got elections next year here, elections in the US, lots of things changing. So that mix you have between domestic and international, how are you expecting that to change and develop into next year?
Yeah, so it's a good question. I mean, this is a UK fund managed by a UK-based asset manager targeting mostly UK clients. So you might naturally think that we've got a pretty high allocation to UK investments. Actually, it's really not. So if you take our shares, so our equity, property and infrastructure exposure, the total allocation to the UK is about 9% of the fund today. So it's actually a really, really small proportion of what we hold. That's more by output than design. Our investors here at Baillie Gifford are really, really quite global in nature. So we've got some industry-leading companies that happen to be based in the UK, Hargreaves Lansdown, GlaxoSmithKline, but we're not dancing to the tune of the UK economy. And to answer your question, I can't really see the circumstances under which that would change. The world is a big place. If we're looking for really resilient and diversified income, it makes sense to kind of expand that opportunity set as much as possible. So it's not an outright call on whether the outlook in the UK is positive or negative, but it doesn't keep us up at night because we know that the majority of our income is derived globally rather than here.
Excellent. Now, look, we are running out of time for questions here. So I'd like to just build on that by finishing up and asking you, Tom, to please put on your fortune teller hat, as everybody loves to do, and share a little bit about your outlook for inflation and interest rates in the short and medium term.
Yeah, so we've got 4 fund managers on this strategy, and one of them, Stephen Hay, trained at the Bank of England before moving into asset management. So he spent 7 years advising the Monetary Policy Committee at the Bank of England. So here at the Edinburgh office, we do spend quite a lot of time thinking about inflation and interest rates, which might be contrary to what many people expect about Baillie Gifford, but it directly impacts this strategy. I'll take those in turn. So with inflation, Stephen's view, if you were to ask him today, is that inflation is going to be more volatile going forward. There are various factors that support that, whether it's the increasing share of growth going to labour rather than capital, or the sort of deglobalization that we're seeing in many places. All of that points towards slightly more volatile price changes in the next few years across the developed world. In terms of interest rate outlook, it's, yes, on balance, interest rates probably have peaked, and partly because the decline in inflation has been so stark. And in some parts of the world, we're seeing, economic weakness, particularly in the Eurozone, for example. So where are we headed on interest rates? Well, I think the market's telling you that they're going to go down, and maybe we're in for a tougher growth environment during the next year. Bringing that all together, what's the risk? Well, I think there's a real risk here that clients worry about all these different things happening at the same time, hunker down in cash. And then what they find is almost bad news in the economy is good news for asset prices. And then they're forced to have to buy those assets at higher prices. So it's a real psychological battle. It's a psychological battle for asset managers as well as the end investor. But we have to sort of think big picture, what is the best mix of assets that is most likely to deliver a monthly income that the clients can rely on, but also keep pace with inflation during the next 5 years. And finally, what I'd say on that is, that task is less daunting today than it was a few years ago. That valuation reset has really, really changed things. So for a strategy such as this, keeping pace with inflation, really, really tough in the short term. Frankly, there are very few ways to do it over short periods of time. But looking ahead, we think for a strategy like this, it should be set fair during the next few years. So cautious optimism, I'd say.
Well, a wise and positive note for us to end on. Thank you very much for that, Tom. Now, before we wrap up, let's just take a quick look again at the learning objectives, which will be up on the screen now. That's all we have time for today. So thank you very much for your questions, and thank you to Tom for joining me. On that note, if you have a question that did not get answered, Tom and the Baillie Gifford team will do their best to do so after the event. Now, before we close up, just a reminder that your CPD will be delivered tomorrow. And also a quick note, if we can't see your full name on the Zoom call at the moment, if you could please make sure that you just message that into the chat box just so that we know who you are. Now, let me just leave you with a little bit of a teaser of what's to come from PA events as we head through Christmas period and into the new year. So next Tuesday, the 12th of December, we will be closing out the year with Schroders and a review of their ever popular financial advisor pulse survey, as Gillian Hepburn, Doug Abbott, and Unique Financial Planning's Philip Martin discuss the thoughts of advisors as we move into 2024 in what will be our last digital working lunch event for this year. After the break, we're straight back into action with our first digital working lunch on the 17th of January, where our partners will once again be Baillie Gifford, and details of that presentation will be announced on the PA website very soon. In the last 2 weeks of January, we'll be back on the road again for our traditional Q1 multi-asset roadshow, where we'll be joined by speakers from Schroders, Orbis Investments, Morningstar Investments, and 2 more to be announced very shortly. Our keynote speaker on this roadshow is going to be Morningstar Research's Head of Research, John Miller. On the 23rd of January, which is Tuesday, we will be at a new venue for PA, which is the impressive Alton Hall near Leeds. Then on the Wednesday, the 24th, you will find us in Warrington, and on the 25th at the National Conference Centre in Birmingham. The following week, we'll be back in Bristol, and that will be on the 31st of January. And we will be finishing up the roadshow in London on the 1st of February. So all in all, that is a total of 4 hours of CPD over the next few weeks. And as ever, if you wish to find information on or sign up to any of our events, you can do that by visiting professionaladvisor.com/events. So that's it for today's session. All that remains is for me to thank you, our readers, for your company today. I trust that you found this session helpful and worthwhile. And if you did, perhaps we will see you next Tuesday for the Schroders Digital Lunch discussion. Thank you very much and goodbye.